Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show. Hello, everybody. Today on Tech Guys Who Invest, we discuss a topic that is fundamental to a successful investing journey, your investor identity. We discuss why this foundational concept is so important, what you need to know to form your own, and some examples. We hope you enjoy this episode. Hey, Kevin.
What's going on, Adam?
Not too much. What's up with you?
Just another day in paradise. And I think today we are talking about something that's pretty near and dear to our hearts as we're refining this particular topic in our lives.
Yeah, I'm pretty excited about this one because it's super relevant for both of us, Kevin. Kevin, what is your investor identity?
Well, now that the cat's out of the bag, that's a great question, Adam. And personally, I'm looking to purchase first position performing and non-performing notes really anywhere in the US. So, Adam, now that you asked me, I have to turn the tables and ask you, what is your investor identity?
Kevin, my investor identity is 5 to 20 unit apartment buildings in the Tampa Bay area. And I'm looking for class B or C, mom and pop owned, value add opportunities. There's a little more that I think each of us can expand on, but that's my base investor identity.
Nice. That is your anchor for who Adam is as an investor, right?
Right, exactly. And I think here in a few minutes, we'll probably get into a little more details for each of us. But why are we even talking about Kevin? Why is this even important?
Yeah, that's a very good point. So in our last episode or in one of our previous episodes, we talked about the shiny object syndrome. And to summarize that in a nutshell, it's where you are so distracted that every aspect of investing where you can make money, you kind of cling on to, but you never pick one for a duration long enough to actually make money, to actually learn enough to pull the trigger on something. And establishing your investor identity is one of the best ways to make sure you don't fall victim to the shiny object syndrome. Adam and I invest in what we just talked about. If it doesn't fall into our criteria, let's say somebody comes to us with a single family home, Adam and I will say we're not interested, but we can, help point you in the right direction. Find somebody, because Adam and I both believe in abundance. We aren't the investors who invest in single family, so we'll push it along. Otherwise, it would be, oh, this sounds kind of cool. Let me look into this. Now I've just wasted time trying to analyze this opportunity, trying to find resources to take down this deal when I should be focusing on the thing that I care about the most. And to that point, it's all about making sure I'm focused and my time is effective as opposed to just being productive. So, Adam, am I missing anything when I kind of just described why the investor identity is important?
Yeah, I think that the focus piece you mentioned is really, really important. That's huge. And I think there's a lot around that. As you described, it helps keep you from going off into the wrong direction, but it also lets you know you can let others know what you're doing that way. You really get it down. You get to know your area very, very well. And as we talked a little bit about in a previous episode, this is a lot of work. It is a lot of work to understand what your investor identity is very, very well, because we're professionals at this. We want to be very good at it, especially when we're working with other investors' capital or we're partnering with other investors. It's important that we perform very well, and we need to be experts in our area. So it's hard to be an expert at everything. This helps us stay focused and really get to know one area very, very well and become the expert at it.
Agreed. You can't become an expert at everything simultaneously. I think maybe down the line, if you're a 30-year veteran, you may become an expert in single family flipping. You may become an expert in multifamily investing, but there's a duration where you're saying I'm going to stick to single family investing for 5 years. That's all you're going to care about, and that's what we're alluding to is that hyper focus to get something done is huge with the investor identity.
Yeah, and it's a great way to keep it top of mind to be able to tell people quickly and succinctly what you do. And that will help you find deals. It will help you connect with other investors, and just make good progress. When someone bumps into you or you're talking to somebody at a networking event and you're talking about what you each do, if you have that focused investor identity, you're able to clearly communicate to them exactly what it is you do. And that can really help move things forward for you.
Exactly. And to build upon that point, let's say, for example, you are going to network for your day job. You know exactly what you do. And to grow your own business, somebody asks, hey, what do you do? What like types of customers are you looking for? That is the same idea as your investor identity. So instead of saying, what do you do? Or it could be the same thing. Somebody asking, what do you do or what do you invest in? You can say, hey, I'm looking for X, Y, and Z properties in ABC location. And that person will say, oh, that's great. And maybe down the line, they may end up knowing somebody who has something in that area that they can refer you to. So to Adam's point, it's once you establish what your investor identity is, it's significantly easier for others to help you out as well.
So, Kevin, it feels like we're kind of on, in the neighborhood of marketing, and this almost feels like there there's a marketing aspect to this. Would you agree with that?
Absolutely, 100%. And to that point with marketing, there's nothing wrong with letting people know what it is you're looking for. I think you should be because you can only do so much as an individual, right? You can look at so many houses in a given day. And if you're a busy professional, that time is greatly reduced. If you add additional aspects of life like working out or a family, that time gets further reduced. However, if you're letting other people know and you're building those relationships, investors tend to think more of an abundance mindset. So it's like, oh, Adam is a multifamily investor. This isn't for me, but I know Adam would want this, and I could forward that information to Adam. So by marketing, you're telling the world, hey, this is my message. This is how I am trying to grow a business. If you know anybody, let's do a deal together.
Kevin, what do you think about some things that someone should consider when forming an investor identity? Maybe some of our listeners don't have one formed, and they're thinking about it and want to know what are some things to consider.
I think the most important thing to consider is, and remember that it's um, your own investor identity is up to you, right? Don't get into the weeds of like, oh, this person's doing this, I should be just like that. Because their life situation, their motivation to invest is not going to be exactly like yours. So I think that is the first thing to accept, that your investor identity is your own thing. And there's no wrong answer to the investor identity. And like all the things that are unknown, the best place to start is to ask questions. For real estate, for example, I like to understand why I'm investing in real estate. What about it interests me? Because if I'm not interested in it, I'm not going to spend a lot of time and all this effort if I don't really care enough for it. What's another question that you might ask yourself, or the listeners could ask themselves, Adam?
For me, it's really ensuring it aligns to my vision. You mentioned knowing why you invest in real estate. And for me, that's very important. Understand what your why is, and it really needs to be a lot bigger than yourself. It needs to be something that is much bigger than you. Why are you doing this? What's your real vision? And your investor identity should align to that. So, for example, if your vision is to leave a legacy for your children and your ancestors and build generational wealth, then you might have a different investor identity. You may be looking at investing in very large commercial properties versus if your investor, if your why is something more around being able to quit your day job, then you might be okay with house flipping, right? It can totally depend on what your why is. So I think that's a really important key to it.
Yeah, I would also say, speaking of flipping houses, how much time do you have to dedicate to real estate investing? That's another thing. If you want to be truly passive, you want to spend like an hour a week or something like that, you may want to invest in REITs, which is an acronym that's REIT and stands for Real Estate Investment Trusts. And basically, those funds are operations where they purchase performing real estate assets, and you can invest in those companies to give them capital to purchase those properties, and you treat it like owning part of the company. So think of it as a stock for another publicly traded company like Apple or Google.
Yeah, that's a great point too. And what Kevin's talking about here is passive investing. That's a situation where you invest capital with an investor, and it can be with REITs. It can even be with investors like me or Kevin, people who invest and actively are always looking for capital. So if you would like to invest your money, but not have to do all of the hard work and the spend all of the time doing this, you still have a way to do that, and that's your investor identity. And like Kevin said earlier, that's completely okay. What we're doing is no better or no worse than that, and it's your own. So, yeah.
Another thing I think we should discuss is risk, because whatever you're investing, whether it's stocks, bonds, mutual funds, real estate, bamboo, whatever assets, precious metals, there's always inherent risk. There is no such thing as a guaranteed return. So it's important to understand what your risk tolerance is and what it should be, right? I think that's also something, because you can be towards retirement and be kind of a gambling person, but that's not necessarily the wisest thing. Maybe I'm speaking because I'm more of a conservative and I'm looking for ways to grow wealth, not necessarily just double down and gamble. But understanding your risk tolerance is huge for your investor identity.
Yeah, I couldn't agree more. And Kevin, that's one of the reasons I invest in real estate because I have a very low risk tolerance. And before I adopted this wealth mindset that I've taken on, I looked at things in a much different way, backwards almost. And I thought investing in my mutual funds through my programs at wherever I was working or through a retirement account through my advisor would be the least risky way to do that. And now I look at it completely opposite. I think it's much riskier than investing in real estate.
Can you expand on that? Why you feel it's much riskier than real
Yeah,
estate?
absolutely. And could probably fill an entire show with this topic. There's a lot to
Yeah.
say around it, but for our time here today, I'll just say that it's about control. With real estate, one of the reasons I love investing in it is because I have multiple ways to control the success of the investment. And since I'm an active investor, there are a lot of things I can do to make sure the investment is successful and profitable. But with mutual funds or stocks or investments like that, it's much more out of my control. I mean, I can't really control how well the leadership of that company is going to run it.
Yeah, absolutely. You are putting your faith in that entire fund. So one thing that Adam and I have not mentioned, which I'm hoping our listeners have caught on to, is we haven't talked about money. And there's a big reason why Adam and I don't consider the question of how much money you have to invest in as part of your investor identity, is because to think it's limiting belief to say, oh, this is too expensive, or I don't have enough capital to do this. Once you start thinking that, you're introducing that seed of doubt, and you will most likely become paralyzed by that doubt and never really take action. So to instead of thinking or limiting yourself to thinking, man, this is too expensive, start thinking about how I can afford this. As Adam and I are mentioning, there are friends and family who have money just sitting in savings account where the return is technically them losing money because the savings interest doesn't beat inflation, or they have retirement accounts where they want to try something different. So the money is out there. It's a matter of you being able to think creatively and opening up your thought process that way.
Yeah, that's a good point, Kevin. One last thing that I can think of around this topic is it should fit with your likes and dislikes. So it really should line up with what you enjoy doing. I think that's very important to be a part of your investor identity.
Agreed. And for example, I think to expand on that, my dad and his generation, for some reason, they can fix anything. At least that's what growing up was. Oh, something broke in the house, my dad would fix it. He'd find some way. And this was before YouTube or the internet, right? But for me, if you give me a hammer, sure I can nail some things in, but I'm not a handyman by any means. And frankly, I don't really have an interest in doing that. And with note investing, I won't ever have to swing a hammer. And you could argue that if you're flipping houses, you never will either, or if you're an apartment um, investor, the same thing applies. But again, to Adam's point, it's knowing what you like and dislike. If you like getting your hands dirty, you could do something like a live and flip. And I think, Adam, you've done something like that, right?
Yeah, I have, Kevin, and I do like that. I mean, I'm a handyman and enjoy doing things or fixing things around the house, and we've done a live and flip. We When my wife and I first got married, our first house was a live and flip. We rehabbed the whole thing ourselves, and we didn't even really know what we were doing, which is kind of interesting. But we didn't realize that that's what we were doing. We just saw it as a good opportunity. We could buy the worst looking house in a pretty nice neighborhood, and it was trashed. So we could come in, and I knew that I could work when I got off work on nights and weekends to fix it up. And we did that. And we didn't realize at the time we were going to be selling it so soon and moving to Colorado. So when we did, we were shocked at how much profit we made on the house. It was awesome.
That's awesome. So you were doing something, but didn't really know what it was called, and it just turned out to work out well.
Right. Yeah. And actually helped us be able to move to a city with a much higher cost of living.
So, Adam, you mentioned earlier that we're going to dig into our investor identities a little bit. And for our listeners out there, could you explain what you mean by value add and then like mom and pop owners?
Yeah, absolutely, Kevin. A value add opportunity it's an opportunity where you have different ways you could increase the value of the asset. So, one example is if the building has been run down and not maintained very well over the years, and therefore rents are pretty low. So, somebody's just kind of renting to a lower class of tenant. They could be in that building if it was pretty nice. That's a value add opportunity. So what you can do as an investor is you purchase the building based on the revenue it's generating now, and then you fix the units up so they're nicer, and then you raise the rents to meet that new nicer improvement, and now your asset is generating more revenue, so it's worth more. So you've just added value to it. Another example would be if it's mismanaged. There could be people who are not doing a good job of managing the property because an apartment is like a business. So, they can be missing opportunities to make it profitable to, generate revenue from the business. So that's another example. And that ties in pretty closely to mom and pop. Mom and pop means the that people own it who it might be like a husband and wife who have just kind of owned this thing and managed it themselves. They're not using professional property management. They're not really, you know, doing things in a way that a professional running a business would do it. They're more casual. They may be keeping sloppy books. They may be keeping, manual records and not even have things electronic, and that's kind of what mom and pop means.
Gotcha. So it's not professionally owned kind of thing.
Right. Right. So yeah, Kevin, you had mentioned a couple of things as well. You mentioned performing and non-performing. Could you tell us a little bit about what those mean?
Yeah, that's a great question. So to take a half step back there, this is in the context of note investing. And for those of you that don't quite know what note investing is, a note is short for a promissory note, excuse me. And if you have credit card debt, or if you have student loans, or if you have a mortgage, you have a note. Now, a mortgage ties that promise to pay to a real asset. Typically speaking, it's going to be collateralized through the house. And if you are a performing note, that means you have a good track record of paying. There's no problems with that. And when you try and purchase a performing note, you can purchase the remaining debt that somebody is paying. And I would come in, for example, and become that bank. And instead of you paying Wells Fargo, you would pay me. If it's non-performing, that means for a certain amount of time, you haven't been paying your mortgage. And there could be a variety of reasons. There's a long list of reasons why that could be. And sometimes life just happens. Medical expenses, for example, are hugely expensive, or they're a huge expense. And sometimes life happens and you can't seem to afford your mortgage. And that's when it becomes non-performing. And at that point, I can come in and purchase that remaining debt for a significant discount. The reason it's discounted so heavily is because you're taking on a higher risk. There's no guarantee that by purchasing that remaining debt that it'll ever get paid off. But with it being non-performing, you have to remember that it's tied to that real asset. So in the event of a worst case scenario, you have to take the house back through a foreclosure or through cash for keys, which is where I would pay the borrower to just leave the property. I would inherit that property. So that property would become mine. And there's a whole different strategy when it comes to now it's yours. You can sell it to a wholesaler, you can flip it, rent it. It's up to you.
Great. Thanks, Kevin. That's very informative. So Kevin and I have talked a lot about what our investor identities are, why they're important, and we would love to hear from you. We'd like to hear what your investor identities are.
Yeah, that's a great point, Adam. And so I think we've said this in the past. We want to reiterate that while Adam and I are passionate about real estate, we didn't call this episode Real Estate Investor Identity. We called it Investor Identity because this concept applies to any type of investment that you're looking to do. And in fact, that would be your investor identity. If you say, I am a value investor, where you only invest in index funds, or I invest in land, that is your identity as well. So just keep that in mind. You could be a cryptocurrency investor. That is part of your identity. So feel free to reach out to us. We would love to hear about your investor identity. And in fact, we'd love to interview you if you have cool stories you want to tell or some knowledge you want to spit and share to our listeners out there.
Great. Thanks, Kevin. Thanks, everybody, for listening. And until next time, that's it for this episode of Tech Guys Who Invest. This is Adam.
And this is Kevin. Thank you so much for listening to us. Don't forget to join our Facebook page, where we're building a community of investors so that we can share ideas, tips, and other ways to help us get out of the rat race. If you found value in this podcast, it would mean the world to us if you could share it with your network. Lastly, we love feedback. It's how we get better. So if you wouldn't mind spending 30 seconds and leaving us an honest review on iTunes or Stitcher or whatever platform you're using, that would be super sweet. If you want to get on Adam or Kevin's calendar, go to tgwipodcast.com/contact. We want to help you invest safely, wisely, and ultimately get you out of the rat race. Thanks again.